The issue being is this asset is in a logarithmic uptrend based on a network adoption model, Metcalfe's law. And so all of the highs are higher and all of the lows are higher. And when you put it on a normal scaling, it keeps looking like a bubble and then this. And when you look back on the chart, these little blips versus this, because it's this gigantic trend. So what you start to realize is the drawdowns are a feature and a benefit if you think about them right.
Hey guys, welcome back to Everyday Finance. In this video, Raoul Pal discusses Bitcoin and crypto. As we continue to navigate the crypto bull market, numerous investors are pondering the optimal timing for their next move. It may be wise to start cashing in on your investments to prevent being trapped in another brutal crypto downturn, which will likely involve significant drops of 80 to 90% declines. According to experts, the current trend in the crypto market suggests a transition from crypto spring to crypto summer. This indicates that there is still potential for crypto asset prices to increase before reaching their peak in 2025. Most analysts estimate that the cycle will continue for another 12 to 18 months. Therefore, it is crucial to make any profit-taking decisions within this time frame. Raoul Pal, the founder and CEO of Real Vision, emphasizes the importance of timing when it comes to profit-taking, as he believes this is an unparalleled investment opportunity for humanity. Raoul believes that the optimal strategy for investing in the cryptocurrency industry involves taking a long-term approach and staying invested throughout both upward rallies and downturns. In a recent video uploaded on his YouTube channel, Raoul Pal, a former Goldman Sachs executive, discusses the issue of downs in the market. He shares the example of his first Bitcoin investment, regretting that he could have made much more money if he hadn't sold when he did. While he recognizes the potential merit of timing the market, Raoul advises riding the wave until at least 2030. He believes that the upcoming technological revolution will completely transform the world. And lots of things Raoul Pal discusses, so please watch the video to end, and share this video, and subscribe our channel, Everyday Finance. Thanks.
Let's talk about the psychology of when to take profits, the cycles that we know are there, and let's just think it through together, because it's going to vary for everybody, and that's a key thing. So as we know, crypto is very cyclical based on this everything code thesis that I've built, which is there's a debt refi cycle that happens every 4 years because everybody reset their interest rates in 2008 to zero and then made all the government debts in around 4 years, 3 to 5 years. And it's created this endless cycle, which happens to be the same as the Bitcoin halving cycle and the US presidential cycle. So we're faced with these cycles. And out of 3 years, crypto is the best performing asset in the world. In year 1, crypto spring, year 2, crypto summer, year 3, crypto fall, and macro spring, summer, fall. And then year 4 is the worst. And the worst is what scars people. And people want to know how to deal with this. So how I think about it first is you've got to establish what are your goals here? What is your time horizon for your investments? So if you're saying, my big macro thesis is this space goes from, let's say, $2.5 trillion today to, let's say, 10 to 15 trillion at the end of this cycle, depending how big this cycle is, to 100 trillion by, let's say, 2032. So we've got the largest wealth generating macro trend of all time, and it's still in front of us. Yes, the early days were super high returns, but it's still super high returns. So we don't want to fuck this up. Right? We want to capture that. So a lot of people start thinking, well, should I trade out in macro crypto fall, try and sell that peak and then buy in the bottom, and then I don't have to go through the horror of the 75% drawdowns? Let's think about this. Firstly, I'm going to give you what I did and the lessons I learned, and then we'll talk about how we can deal with this cycle going forwards so I can help you navigate your needs. And we've all got different needs here. So the first time I bought Bitcoin was at $200 in 2013. I had a 5 to 10 year view that this was going to be worth $1 million. And it was $200. And I discounted myself by 90% for being a moron, thinking that it could go to $1 million. So I said, listen, it's worth $100,000. This is $200. This is the best opportunity I've ever seen. So I treated it like a call option at the time. So I didn't put a huge amount of money in, but a decent size. And I said, right, I'm just going to forget about it. It kind of went up like a rocket ship straight after that. And I was up 5x or something very quickly. And I was like, oh my God, I'm clearly George Soros. I'm the best trader ever. And then it fell 85%. And I just didn't worry about it because it was a call option. At the time, I thought, well, it could go to zero. So I'll just see. Let me play this out. That's a macro time horizon, long-term time horizon. And I thought if I just hold it long enough, we should generate huge returns. By 2017, crypto's taking off again, and it's at $2,000. And I was now up 10x. And the Bitcoin forking wars happened.
With the looming threat of inflation, traditional fiat currencies are facing significant challenges due to various economic factors. Alternative assets such as Bitcoin have been receiving more attention lately as potential hedges against certain phenomena. One question that arises is whether Bitcoin can effectively hedge against inflation. To determine this, let's take a closer look at some of its key properties. There is a limited supply of only 21 million Bitcoins in existence. This cap on Bitcoin's supply makes it immune to inflation caused by excessive money printing. Additionally, Bitcoin is decentralized, ensuring that no single entity has control over it. Bitcoin operates on a decentralized network of computers, which helps protect it from government manipulation or interference. This characteristic can be beneficial in terms of maintaining its value and guarding against inflation. Bitcoin's digital scarcity and increasing adoption make it a compelling store of value, much like gold, which has long been used as a hedge against inflation and market volatility. The price of Bitcoin has been extremely unpredictable, with significant ups and downs occurring within short time frames. While some people consider this volatility to be a hindrance to its effectiveness as a hedge, others view it as a potential chance to make gains during periods of inflation. Ultimately, the effectiveness of Bitcoin as a hedge against inflation relies on several factors. These factors include the level of adoption as a store of value, regulatory developments, and macroeconomic conditions. Therefore, it is crucial for investors to carefully assess their risk tolerance and investment objectives before allocating funds to Bitcoin or any other asset class. Let's get back to Raoul Pal interview.
And I mid-curved it. Mid-curving it is, if you remember, is when you're overthinking a very simple trend, which is, you can be the moron on the left or the Jedi Master on the right, but in the middle is where you do all of the overthinking. The moron on the left is it goes from 2.5 trillion to 10 to 15 trillion to 100 trillion. Just do that. Everything in the middle is regulation. It's what about, what happens if somebody replaces the tokens that I've got? It's what about forking? It's all of these things. They're all noise. So I succumb to the noise. I'm like, I don't know what this means. Do I switch into one, Bitcoin Cash or whatever? Stupid. And so anyway, I took profits and I was up 10x and I thought I was great. And then it went up another 10x in the next 9 months. 2017 was staggering. I'm like, oh, wow, okay. But I wasn't worried because I've made 10x. So I try not to have regrets about positions. And then it fell, and it fell 85% as usual. And 2018, there was all the tether fund at the time. There was a whole bunch of misery around the 2018 19 bear market. So 18 was that terrible year. Then it bases in 19, starts rising. I start watching it and then start digging in, doing the homework of, do I want to get back in meaningful size? And then I'm watching the chart pattern, looking for an entry, and it does this massive kind of wedge pattern, gets to the top, tries to break out, drops into the middle on the COVID massive sell-off. And I'm like, this is the opportunity because I know this chart pattern, the likelihood it's going higher. And so I got in there and I massively sized up what versus my original bet. Maybe it's 6-7 times bigger than the first time I went in. And I've added since. Okay, so how did I do? I felt great because I bought it low, sold it into a big rally in one cycle, then bought it. I'd ridden one cycle all the way up and down, rode the other one up, sold out, then rebought into maximum pain, the down 50% day. And then the breakout of 10,000 above that. I thought, yeah, I've done pretty well with this. I then went back and looked at what happens if I just kept my original bet, which was much smaller. I would have made 5 times as much money by not doing anything. That kind of upset me a little bit because I thought, I was a macro guy, I traded it well. No. The issue being is this asset is in a logarithmic uptrend based on a network adoption model, Metcalfe's law. And so all of the highs are higher and all of the lows are higher. And when you put it on a normal scaling, it keeps looking like a bubble and then this. And when you look back on the chart, these little blips versus this, because it's this gigantic trend. So what you start to realize is the drawdowns are a feature and a benefit if you think about them right. So this time around, I then calculated, okay, what happens if I just added my original size? Again, it wasn't the biggest bet in the world, but it was good enough. Every time we had one of these massive drawdowns, so crypto winter. And let's assume again that Raoul's a total moron. He misses the low by 30% because market timing, this stuff is hard as hell.
Regarding Bitcoin, during the month of June, which marks the beginning of the following month, the cryptocurrency market can reach its local bottom. Altcoin bull cycle. According to market analysts, based on historical chart patterns, altcoins could be ready to find their local price bottom around the beginning of June, according to famous crypto analyst W Capital, who said in a May 8 X-Post, altcoins are following the plan flawlessly, altcoins are following the plan precisely. The market for alternative cryptocurrencies has taken a battering in the past month. The market valuation of alternative cryptocurrencies, which excludes the 10 largest cryptocurrencies, dropped by more than 21% during the previous month to $265 billion. Altcoins reached their lowest point in early February. Altcoins sold off around the BTC housing altcoins to their lowest point early June. The M2 money supply is an estimate of all cash and short-term bank deposits nationwide in the United States. As the money supply in the largest economy in the world expands, a portion of the new money supply is also increasing. The supply might potentially make its way into other cryptocurrencies and NEIC coins, which would contribute to the commencement of the alt-son. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance. And we will meet in next video. Thanks.